So, in yesterday's video, we looked at how to determine whether a particular stock is comparatively strong, technically strong, and fundamentally strong, or comparatively weak, technically weak, or fundamentally weak. So, this is how you begin categorizing your stocks. Now, this leads to 8 different scenarios, out of which I will discuss 4 in this video and the next 4 in the third part of this mini video series. Okay. So just to summarize the previous video, for comparative analysis, we look at relative strength of the stock and the industry, and we look at institutional demand. Technicals, we are asking only 3 questions. Is the stock in an uptrend? Is it forming a base? Is it in early stage, middle stage, or late stage? In fundamentals, we are looking at sales, margins, earnings, and return on equity. Okay. That's how you begin with. This will help you determine whether the stock which is there on your watch list, how strong it is in each of these departments, or whether it is strong or weak. Okay. Now let us look at the 4 scenarios. Now, in these 4 scenarios, I am assuming that the stock is comparatively strong, which means it has got good relative strength, preferably 80 or more. It comes from a leading industry group, so the rank of the industry is between 1 and 40. This is for those who are using MarketSmith. If you are using TradingView, then leading stock and leading industry group means that you are only looking at the top 20 percentile of stocks or the top 20 percentile of industry groups in terms of their past performance. Institutional demand, in MarketSmith, these stocks have A or B rating as far as institutional demand is concerned. For those using TradingView, you can check institutional demand on the weekly chart. If the stock is going up on high volume on the weekly chart, and if it comes down on low volume on the weekly chart, that is a sign of institutional accumulation. Okay. So for this video, I am looking at only those stocks which are comparatively strong. Okay. So I have drawn this little diagram for you to make it easy. Have a look at this. Okay, comparative. Let me pull the pencil here. Yeah. So have a look at this first scenario. This is our first scenario. Okay. Let's say the stock belongs to this category. It is comparatively strong. It is technically strong. It is fundamentally strong. Let's say the stock on your watch list falls in this category. How will you approach the stock? First question, what is the type of trade that we are looking at? Obviously, it's a positional trade. It is not a swing trade, right? Because it is technically and fundamentally strong. What is the risk in the stock? The risk is low in the stock because it is showing strength in all the 3 departments. What should be your position size in the stock? Your position size should be on the higher side. Okay. So let's say your normal position size is 10 to 15%. You will not hesitate putting that much amount of your portfolio in a stock like this because it is showing strength in all departments. It is giving us what we need. How will you execute the trade on the 15-minute chart? Well, the moment the price starts to go up, the moment it touches the yellow line, you check the volume on the 15-minute chart. If the volume is above the blue line on the 15-minute chart, the blue line is the 50-period simple moving average of volume. If the volume is above the blue line, price touches the yellow line on the 15-minute chart, you start buying the stock. Okay. Remember, I have 2 yellow lines on the chart. One is the actual buy price, and another yellow line is 1% above that. So I create a band, which is a 1% band. So you start buying the stock as you see more volume coming in. So if you plan to buy, let's say 500 shares. So the moment it touches the yellow line, you check volume is coming in, it's high. You buy a couple of 100 shares, wait for 1 or 2 minutes, see whether price volume is coming or not. Price volume confirmation. Buy another 100 shares, again wait for 1 or 2 minutes, see whether price confirmation, volume confirmation is coming or not. Buy another 100 shares. So like this, in that 1% band, make sure you complete all your share purchase because you planned to buy 500 shares in that particular band. So never buy a stock which has gone beyond that yellow band. Okay, because then you are buying an extended stock. Similarly, never buy a stock below the first yellow line because that way you are buying a premature stock. So if you buy above the band, you are making a mistake because you are buying an extended stock. If you are buying below the band, you are again making a mistake because you are buying a premature stock. So your timing has to be perfect. It has to be your execution price has to be on in that yellow band. That is why I go to the 15-minute chart and the bar on which the candle on which you buy the stock, there should be high volume coming in at least on the 15-minute chart because generally breakouts happen early in the day, mostly in the first hour of the day. You don't have the daily volume to confirm, so you have to rely on the lower time frame chart. Now let's say you execute the trade properly, it does well during the day, it closes above the yellow line, the volume closes above the blue line, do nothing. That is how you will manage the trade because that is what you planned to do. You will hold on to the stock as long as it remains above the 50-day simple moving average on the daily time frame chart. However, in trade management, if the stock begins to come down on the breakout day, I have made a separate video on this. How do you look at price and volume action? If the price starts to go against you, you start reducing your position size. So please watch that video. I think the name of the video is price and volume confirmation on the day of the breakout. Okay. So I discuss 4 scenarios there. Sometimes you get both price and volume confirmation. Sometimes you don't get any confirmation. Sometimes you get one of the two confirmations. So what do you do in those 4 scenarios on the breakout day for this kind of a stock, which is technically and fundamentally strong? So please watch that video. Okay. What I normally do is on the breakout day, if the price starts to come down, it means the stock is not doing what I expect it to do. So I immediately start cutting at least 50% of the position. But if the stock is doing what I expect it to do, it is closing above the yellow line, the volume is closing above the blue line, I don't do anything. I just hold on to my shares because I'm getting what I expected from the market. So that's trade management. Trade management is about managing the stock or position on the day of the breakout as well as after the breakout. So this is a stock to which I will not give more room. Sorry, this is a stock to which I will give more room to fluctuate. This is a stock to which I will give more time. When I buy the stock, I will not immediately try to sell the stock if it starts to come down from my buy point. I will wait till the end of the day. So the market in India closes at 3:30 p.m. So I will wait till 3:25 p.m. Okay. I will wait till that time, just 5 minutes before I will check on the daily time frame. Is the volume above the blue line? Is the price above the yellow line? Okay. If that is the case, I will not sell any shares. If one of them is missing, I will sell 50%. If both of them are not giving me confirmation, I will sell 75%. But I will not sell all shares because, this stock is doing comparatively, technically, and fundamentally strong. So why should I sell all my shares? And the reason why I reduce my position size is that is the best way to manage risk in my view. There are two ways to manage risk. One is by reducing your position size on the day of the breakout. Okay, so that you don't get stuck in a stock which is going against you. Another is you start playing around with your stop loss. You start to move your stop loss up as the stock is coming down. I personally don't like to play around with the stop loss. Okay, so I adjust with position size. Imagine this analogy. Okay, there is a bucket. Okay, and you want to fill this bucket with a tap in the bathroom. Okay, so you get to decide the speed with which the water will fall from the tap to the bucket, right? So you have a tap here and you can adjust the tap in such a way you can determine the speed at which the water will fall in that bucket. Similarly, Position size represents that tap. You get to decide how much money you want to pump in into this kind of a stock. So for this stock, I will let the tap open free. I will put in maximum position size, whatever normal position size means to me. For some people, normal position size could be 10 to 15%. For some people, normal position size could be 5%. For some people, it could be as high as 25%. But one guideline I would like to give you as far as position size is concerned, go with a minimum position size of 5%. At least that much you should put in a stock. And minimum position size 5%, maximum 25%. Never put more than 25% of your portfolio in a particular stock, at least when you are making the initial purchase. When the stock has gone up, you can add to the stock. So the stock could become 25 to 50% of your portfolio on the second base, but not on the first purchase. Okay. Next scenario. So I have spent considerable amount of time just discussing a stock which falls in this scenario. Okay. Now let's look at second scenario. This is the second scenario. So the stock is comparatively strong. It is technically strong, but it is fundamentally weak. So maybe the earnings growth recent quarter is minus 35%. Okay. What is the type of trade we are looking at? Is it a positional trade or is it a swing trade? It's a swing trade. Okay. Because the fundamentals are weak. What is the risk? Well, the risk is low because the stock is showing comparative strength and technical strength. So ideally, the risk is low. However, the risk is high relative to this scenario. You understand what I'm saying? So the risk is a relative concept. When I say risk is low, I am only looking at this stock independently. When I say risk is high, I am saying the risk is high relative to this scenario. Okay. So since the risk is high relative to this scenario, obviously the position size, is it going to be higher or lower compared to this scenario? Obviously, it is going to be slightly lower compared to this scenario. So if you are putting 10% in this scenario, probably in this scenario, you might put 7.5% or 5% of your money in the stock because you are going towards higher risk. When your risk increases, you should go in with a smaller position size. Is that not a very good way of managing your risk? Okay. Next, trade execution. Trade execution happens on the 15-minute chart. Now, this is a stock. This scenario, it's a stock to which you will give more time after you buy the stock. You will not immediately sell. It's a stock which you will allow more room to fluctuate. Now you come to this scenario. Since your risk is high, you will give less time compared to this stock. So for this stock, you are waiting till the end of the day, like you are waiting till 3:25 p.m. to figure out how the day is closing in terms of price and volume. But this stock, you may not want to wait till the end of the day. If you buy the stock on the 15-minute chart, it starts to come down. Okay. You might give it, let's say, 1 hour or 2 hours maximum. Don't not more than that. If the stock is not doing well in that time, you take whatever loss you are incurring in that particular time period. Okay. Don't sell it immediately in 5 minutes or 1 or 2 minutes. Give it some time, at least 1 hour, 2 hours, maybe the volume will come. Okay. The stock, because the stock is not that bad at all. It could have very high relative strength, let's say 94 relative strength. Industry rank is in the top 10 industry group. So this is a stock that you want to hold on to. Maybe the fundamentals will improve next quarter. You never know. So at least give it a couple of hours or at least give it 1 hour. Of course, you will not give it the entire day because it's a swing trade and the risk is relatively high compared to a position trade. Okay. So you understand what I'm saying? When the stock hits the yellow line, immediately look at the volume on the 15-minute time frame. If the volume is coming in, you buy the shares. Or one more thing you could do for this stock, you could wait for a close above the yellow line on the 15-minute chart. Okay, because since the risk is higher, wait for a close. Immediately don't buy the stock. Now, what's the risk in that? Well, if you wait for a close, maybe during that 15-minute period, the price might cross that yellow band. Okay, remember that 1% yellow band? In that 15-minute period, what if the price crosses the yellow band? So if you wait till the close, you will miss the stock because now you're buying an extended stock. So it's a very tricky situation. So for a swing trade, ideally I would wait for a close above the yellow line. But if the volume is coming in extremely rapidly, the price is moving extremely rapidly, the probability is very high that it will close above the yellow line, in which case you will miss the stock. Okay. So if your plan is to buy, let's say, 500 shares of this company, what I would suggest is start buying 100 shares. Okay. Start, if you see more price and volume confirmation, buy another 100. If you see more price and volume confirmation, buy another 100 shares. Buy the stock, wait for a couple of minutes. Buy the stock, wait for a couple of minutes. Buy the stock, wait for a couple of minutes. Okay. This way you will gradually this way you will gradually expose more of your portfolio to this stock. It's a gradual way of getting into the stock. But imagine if you make the first 100 stock purchase, 100 shares purchase, and the stock doesn't move, it starts to go down instead of going up, that too on high volume. Will you buy the next lot of 100 shares? No, right? That's what I'm saying. Play with the position size. Remember that tap and the bucket? You can adjust the tap. Sometimes you might release the tap fully so that the water falls down quickly. And if you feel that the speed is too fast, then maybe you can tighten up the tap too so that the water comes down slowly. So that tap is the position size. So play with the position size. Don't play with the stop loss. Okay. Our goal is not to miss this stock. If it is moving very fast out of 500 shares, even if you manage to buy 250 or 200 shares, okay, you have done a good job of trade execution. And trust me, sometimes you will miss the stock altogether because the movement is so fast. Within 5-10 seconds, you will see the stock just breaking out of the yellow band, and you will not get the opportunity to buy the stock because it has moved up so fast. In such cases, let it go. Do not chase the stock. Do not take additional risk. In your trading career, you are going to take thousands of trades. So don't chase this particular stock. The stock has to give you some 5 minute or 10 minute window to accumulate your shares. If it is not doing that, then don't get involved in the stock. Imagine you go to the railway platform, you wait for the train. Now the train comes at the platform, but it is not stopping, it's moving. If the train is moving, I would not get into the stock. Okay. If the train is stationary, only then I will enter the train. So which means the stock has to give you some time to do the boarding process. What about trade management? Well, your trade management has to be strict compared to this, right? As far as trade management is concerned, what is your objective on a swing trade? On a swing trade, your objective is double digit return in 2 to 4 weeks. So if the stock is doing what you expect it to do, give it some time. Within 2 to 4 weeks, if you are getting a double digit return like 15%, 17%, sell all your shares, come out because the stock was never fundamentally strong. So if you are getting that double digit return in 2 to 4 weeks, while you wait for closings each day, come out of the stock because you have achieved your objective. Don't be greedy. Okay. However, you buy on the breakout day, the breakout is good. Next day it starts to fall. Okay. Then again, start reducing your position size, maybe move your stop loss up, manage the trade. Okay. Try to keep your losses small because this is a swing trade. This is a relatively riskier trade. Okay. So these are the two scenarios. This is how you will handle these two scenarios. Okay. Now, these two scenarios, notice in both the cases, it is technically weak, which means maybe the stock has only 7 candles in the base. We want 10 candles in the base, right? So maybe the stock has only 7 candles in the base. So which means you will have to wait another 3 days for the stock to become technically strong. Okay. So for both of these scenarios, the approach is WW. WW means wait and watch. So this stock, let's take this scenario. It is fundamentally strong, comparatively strong, but technically weak. So maybe there are 7 candles in the base. So wait and watch, wait for 3 days. Let it set up a proper buy point as per our criteria. So then this becomes green. When this becomes green, then you are dealing with this scenario, right? So if you wait for 3 days, this scenario will become scenario number one. And I have already discussed what to do when you get scenario number one. Okay. Similarly, in this scenario, what is happening is it's comparatively strong, fundamentally weak, technically weak. Now, fundamentals don't change overnight. You will have to wait for a quarter. However, technically, maybe the stock has completed 9 candles in the base. So you have to just wait one day for this circle to become green. And when this becomes green, then you are dealing with this scenario, right? And I have already made a detailed discussion of what to do when you see a stock which comes in this scenario. So these two scenarios, you have to wait and watch, allow them to come here in the one of these two scenarios. And I have told you how to manage both of those scenarios. Okay. So that's how you will approach. So these are your considerations. Remember, you only have to master 3 skills to become a professional stock trader. Skill number one, stock selection. Skill number two, trade execution. Skill number three, trade management. Okay. That is why to do proper trade execution and trade management, you have to categorize the stock. Stock selection, you have already done. You have put the filters. You already have these stocks on your watch list. Now, the watch list stocks, you are trying to put them in one of these 4 categories. Okay. That's what I wanted to convey in this video. So I hope you understand how flexible my approach is. Okay. Sometimes I will wait for a close above the 15-minute candle. Sorry, for a close above the yellow line on the 15-minute chart. Sometimes I will wait for that close to happen. Sometimes I will not wait for a close above the yellow line on the 15-minute chart because I am dealing with this scenario. That is how flexible you have to be as a trader. That is why you need to categorize stocks. So these are 4 categories. In the third part, we will discuss 4 more scenarios where these will be red. All of them will be red. So we are looking at stocks which are comparatively weak. So which means stocks with a relative strength of less than 80 or stocks with industry group rank of more than 40 or stocks with no institutional demand. So if this is red, okay, how do you handle the 4 scenarios? This will not change. This combination will not change. Okay. So if this is red, then we are going into even bigger risk. Okay. So the risk component is going to increase in the next video. So we need to be even more careful. We need to micromanage all of those scenarios. Okay. I will see you in the next video. I hope you are liking this video series because just yesterday I received an email from a student uh, discussing trade execution and the doubts that he has. When do you use 15-minute chart? When do you use daily? When do you use weekly? So that is why I have created this 3-part video series. Okay. So I hope this has been helpful to you in your trading journey. Please like, comment, and share this video. Your support has been overwhelming for me. I thank you for your support. I thank you for your support on this YouTube channel. I thank you for your time. That is the most important. The best gift you can give me is your time and your attention. I hope I am adding value to you. Have a fantastic day today. Take care. See you in video number 3, which will come tomorrow.